I'm not there were so many problems. I had an extra layer. I didn't even check myself. I just started because I had this idea that I really wanted to get through. So let's just start from scratch. All right, I'll make it quick. It was 20 minutes of me talking, literally no microphone. Okay, I'm basically TLDR. I'm not a financial anything, but I do enjoy analyzing financial markets. Uh, this channel is not meant to be for this, but I feel that people need to know because it's an important aspect of our society. And finances wasn't really a big focus in our educational system, so providing this sort of side content, I feel like, is almost necessary to keep people updated on what's happening. This is actually a good kind of concept here that I can just breeze through everything a bit quicker because I've already spoken 20 minutes about a lot of stuff. So here's the TLDR. Before I mentioned details about the US 2-year yield and the 10-year yield rates, right? Percentages. You lock your money in for 2 years, you get 4.8%. You lock your money for 10 years, you get 4.4%. That's the current market. And by current, we're talking Sunday, November 19th, 2023. Okay? All right. Now, the general concept to remember is that if you lock in money for a long period of time, that means you can't touch it. And one would expect to get more money back because of the extra time spent locked up. I'm going to check my audio. Okay. Looks like audio is in. So when you lock your money in for 10 years, you expect more money back. But the percentage yield is lower as far as rates go currently. So that means you can lock it in for 2 years, make more, and then lock it in for 2 more years and make that more, and then keep doing it for 10 years. You're going to basically have a higher return, right? Okay, this is a problem. Now, for the case of us kind of going backwards a bit, I'm going to zoom in. This, this is kind of a support, so you don't need to really see this, but it's been bouncing off this red line multiple times, and vice versa over here. Those aren't too crazy important. I'm actually going to remove visuals. There we go. Just to clean up the chart a bit. Now, as far as fractions go, first, if you use TradingView, if you're financially unaware as far as the tools you can use, TradingView is a really cool tool where we can analyze everything from stock markets, crypto, to data. And this is what data includes, our 2-year yield and our 10-year yield simultaneously. Now on the left side, though, focus here, we have a division. And this division is important. So consider the space here, right there. We have the USO2 as the numerator. And then keep in mind, division here. And then the 10-year as the denominator. Okay, keep those values located. We have those two values here as well, just for reference. I'm going to put this bar for division between the top and bottom because that's basically what is happening on the left. The right side, 4.8, is dividing by the bottom side, 4.4. So the thing about fractions is, I know that no one ever said that with any fun inclined, is that the top number, if it's bigger, then we have a big whole number, anything above 1. So 2, 3, 4, 5, 1.5, etc. But if the denominator, that's not the object I wanted to draw. Oh, too thick. This guy, if the denominator is bigger, then we have a small decimal, 0.5, 0.8, which converts appropriately to 50% and 80%. Okay, that is important to remember because now we're going to look at the values, and even though they're so slightly different, or 4.8 versus 4.4, the concept of holding something for 2 years yielding more money back is still appropriate even in the smallest differences. More people will go to the top because they get more money back than the bottom, which is also the number that's being influenced here. The federal rate provides this base standard value, and then if you get a loan for a car, there's like a percentage on top for the loaners to make their own cut, etc. Right? So we don't really loan money for 4.4%, but for a 10-year type of hold, the minimum required is 4.439, and then whoever's loaning the money can put percentages on top. Okay. That's essentially how loans work. They are standardized, anchored down by the Fed rate, which is what we're looking at here. And of course, Fed rate means you can lock your money in with the government, US government bonds, and make some money back from the government. And the government uses your money to invest in the country, provide a higher GDP, and then provide that return to its investors, similar to how essentially corporations work. Now, the very big red flag that's happening currently, and the reason why I wanted to actually speak on this detail, is this 1-to-1 value. Red line. I've marked it as a convenient one. So if we're really thinking about percentages again, if we have a 1 on the top and a 1 on the bottom, this is a equilibrium. 1 divided by 1 is 1. Therefore, that 1 value is a good middle point marker, because anything below is normal lending. People lending for 10 years, making more from the 10-year lockdown. You can't use your money, you make more money over a long period of time. The top now, if we are hovering in the top, then that means people are kind of scared for the 10 years. They don't want to lock their money in for more than 2 years or lower, right? The lower the year value and the higher the percentage means higher and higher fear. So they can essentially risk-free. That's kind of the case here. Anytime we invest, we're looking for low risk. So we can essentially invest low risk in 2 year, because it's less time and it's more money. Less risk, more money. But there's something going on with the 10-year, and it's not catching up. It's a lower percentage, which is where fear happens. Not in the market, but in the loaning system. They don't believe something is potentially stable in the 10-year length rather than the 2-year short term. So that's the focus. I'm going to remove all these extra markers now. And we're really focusing on that red line and where we are in respect to that line. Here we are now. This is our current trajectory. And we are above, meaning that people are scared of the 10, leaning towards the 2. But for the longest period of time, we have been underneath, which is where the decimals happen, where the 10 is larger. So bottom 10 is larger, top 2 is larger. There is a pattern that happens too for every crash, if you want to call predictive manners happening here. If we can predict the market, it's through these sort of loan habits, psychological habits of people when times are tough, loan short when times are good, loan long term. So let's take a look at some, historic events. First, COVID. We were briefly above that 1 value. So for a couple of weeks? 2 weeks. For 2 weeks, we were above the 1.1, and we felt a pretty big crash from it. We have a lot of repercussion from it. 2018, the magnitude can also be essentially read with how much we spent. 2018 wasn't a crazy crash, but there was some, non-stability in the market. It wasn't really broadcasted much. But we touched and we went above the 1 here, ever so slightly, and there were some issues. But notice that for here, 2020 or 22, we had that big breach. Okay, so anytime we go above, there's fear and potentially a recession after. Now, the reason this has to dump like this, go down so hard, is that the government needs to reduce the rate to promote business again. This is basically controlled by the government. This is the only thing that they can control in the market, is this value, this rate. So when it dumps, you know that essentially the government was trying to alleviate some pain by reducing rates strategically. Now, before that, we were doing great. No crashes. In fact, the stock market itself was doing this. This is what I was also going over. It was going up all the way up to that point, 2021 November. Right? So when this value stays under, we get a long period of growth. Well, what happened in the 2008 mortgage crash? Well, there it is. We went over it a few times, but we did hover over it for a bit, and we know how much that hurt the economy. We know the repercussions of it. We're still feeling it today, and some may argue it's not even over yet, because what happened was that the government printed money to help the economy recover and lowered interest rates, right? So there's that one growth, higher value. Here, 2000, the dot-com bubble. Imagine that. We even have the dot-com bubble available to us to see. So this is why many say the indication 89, there was a crash in 89 as well. This is why some say that this is a predictive indicator of a recession. Now, what is the predictive case though? It's actually not when we're above. We're not in recession when we're above or even touching it. We have to go above and then fall down. This downward notion is the recession signal. Now, it can happen anywhere in between. Sometimes it can even happen during the bounces in between. But when we go down hard, that's our indication of a recession. But the problem here is we're still fearful of the future. And if we really go in now, I was hoping we would be going down. Look how close we have been to that 1-1 reversal. Okay. We touched it, COVID, backed out, went over and stayed up there, continuously hovering up above in those levels. This is my concern. We saw that the value or the magnitude of a recession can be essentially correlated to the time spent above this reversal. And in the previous times, we know the magnitude of the 2000 crash. Here, it was pretty big too. A lot of corporations bankrupt, the whole system fell apart. We know about it. We know the repercussions of 2008, and these are the comparisons we have as far as magnitude. This period of time where we were above that 1-1. The problem further is we can confirm not a lot of people felt the 2018. So that was a really teeny tiny touch. We did feel COVID to a certain degree. But now we have recovered and we're back above and even more fearful of the future, and we're staying up here. We have literally become comforted up here, which means that we're essentially waiting for a downward. When we can finally say we're out of a recession is when we go down, and we can probably say it somewhere here. But until that happens, we're hovering on the pre-recession stages. And the more, I believe, personally, theoretically, the more we stay above this line, the harder we're going to fall. And this already looks like a very, very intimidating space that we have made home compared to what we've seen in the past. So I'm looking for this. I'm hoping for this soon. And that's when we're going to know we're out of our recession. Because in essence, here's that coming out of our recession in 2000. Crash, call it a crash. It wasn't a recession for the COVID issues. That was just a purposeful crash that happened because distancing, work from home, stopping of a lot of workplaces. There was just a lot of stuff happening to try and fight COVID. So that's a simple little movement. But we didn't quite go down and get away from it. So we didn't feel the full force of that actual recession. And general terms, the government basically started printing money, right? Or did some sort of financial mumbo jumbo to get through, but in case costing taxpayers and also costing uh, interest rates and inflation. Inflation is really the biggest issue that we can consider done once we're out of this 1-1 space. Maybe a little bit lower down the line. Maybe somewhere down here is where inflation's gonna calm down. We do have some signs of stability with inflation, and we do know that these markets can be manipulated. Naked shorting, and just shorting in general, which can manipulate a value to not be its true value because there's so many hands in there manipulating the number. So potentially we could also be currently going down, but you know, whoever's in the market is keeping us from actually going down, even temporarily. Because if we go one step further, and this is where I'm going to end it, I was hoping we were going to fall. It's the daily now, so each one of these bars is a day. I was hoping from what we saw here, we were going to break down. We were going to go straight through and say, hey, let's get this recession out of the way. Boom, like this. But notice we didn't. So something happened here that may have changed the trajectory. Maybe shorts covering because we know, or going back in, or longs covering. There's just so many things that can happen in the derivatives market, right? So it could be a long cover until then there's a complete going into a short. Those are terms that I haven't really talked about much, but can be researched. So we're now currently going back up, increasing the magnitude of our potential recession. That's my theory. But I think that's important to know these charts, especially if you're going to get loans, if you're searching for housing. Knowing these charts will help you say whether it's a good time to invest or not a good time to invest. So if you're going for a house, potentially the 10-year is pretty low, 4.4, but we've been lower, very much lower. And the goal of the government is to go around 2%. So maybe not the best time to buy a house for a 10-year or 15 or even 30. You might want to wait until interest rates are lower. And so far, based on data, based on the Fed, we know that the inflation is stable, it's reducing. We're not going to see prices change down because that's not the job of the government or the Federal Reserve. They're just there to stop the prices from going up higher. That's the goal. And sadly enough, that includes slowing down the economy to prevent overspending, which is a supply-demand thing. That's essentially how we can get inflation. But that's it. That's the boring stuff. It's actually very interesting to see this. We could be down. We may not have a recession, so that's good for us. But this is kind of the indication that as soon as it crosses down, I'm going to be calling for something crazy to happen. So enjoy the rest of your day. I just really wanted to go over this.